Hello. Japan's banking sector is entering a major turning point. For almost 3 decades, Japanese bank operated in a world of extremely low and sometimes even negative interest rates. That environment made it very difficult for banks to earn a strong profits from normal lending activity. But now, as interest rates rise, banks are finally getting a chance to earn better margins again. The big message of this slide is that higher rates are good news for banks, but the benefit is not equal for everyone. Large banks are better positioned because they have scale, stronger technology, more diversified businesses, and larger balance sheet. Smaller regional banks, however, face a tougher situation. They may benefit from higher rates, but they are also carrying the hidden risk, especially low return bonds during the zero rate era. So, this is not simply a story of banks are winning again, it is the story of two Japans. The big banks that can use the higher rates to grow stronger, and the smaller lenders that may struggle as the old problems become now more visible. This slide explains why the shift in Japan's interest rate policy is so important. For nearly 31 years, Japan lived with ultra low rates. The Bank of Japan kept the rates close to zero because the country was struggling with weak growth, low inflation, and deflationary pressure. But now the Bank of Japan has moved away from that old world. The policy rate has risen to 1%, which may sound small compared to the other country, but for Japan it's a historical change. For banks, this matters because their business model depend heavily on the gap between what they pay the depositors and what they earn from lending. When the rates were near zero, banks could not earn much from the loans. Their net interest margins were weak, but as the rate rises, the gap improves, giving banks a better chance to make money. That is why Japanese banks are cheering the end of the zero rate era. However, as the slide reminds us, the next question is whether the smaller banks can keep up with this new environment. Here we see the clearest winners from Japan's trade shift. The mega banks, MUFG, SMBC, and Mizuho have all seen strong growth in the net interest income since March 2024. This slide shows increase of around 37% for MUFG, 32% for SMBC, and 28% for Mizuho, with an average increase of about one third. This is important because the net interest income is one of the most basic way banks make money. When the banks can lend at a higher rates while managing their deposit cost, profit improves. For Japan's biggest bank, the return of higher rates has become a major earning boost. But the reason they are benefiting so strongly is not just higher rates, it is also their scale. These banks have larger customer bases, diversified revenue sources, stronger digital platform, and more capacity to absorb the risk. So higher rates are helping the whole banking industry in theory, but in practice, the biggest banks are capturing the strongest gains. This slide explains why the large banks are pulling ahead. Between 2022 and 2025, the share prices of the larger Japanese bank rose far more than those of the smaller banks. The slide compares the smallest 20% of the Japanese bank with the largest 60%, showing that bigger banks gain much more. The reason is simple. Banking rewards the scale. Large bank can spread fixed cost across more customers and more assets. For example, if a bank needs to invest in digital banking, cybersecurity, or compliance system, those costs are easier to manage when the bank has millions of customers and a larger balance sheet. Big banks also have the better diversification. They are not dependent only on the traditional lending. They can earn income from investment banking, wealth management, brokerage services, international operations, and fee-based businesses. Smaller banks, especially the regional lenders, often depend more heavily on local deposits and local loans. That makes them more vulnerable when the local population decline or when the loan demand is weak. So the key message is that higher rates help the bank, but scale decides who benefits the most. This slide focuses on one of the biggest hidden risks facing the smaller Japanese bank: low return bond portfolios. During the long period of the ultra low interest rate, many banks bought government bonds and the other domestic bonds that offered very low yields. At the time, this seemed safe, but when the interest rate rise, the market value of the old low yield bond falls. The slide shows that the bank hold around 150 trillion Japanese yen, or about 936 billion US dollars in domestic bonds. That is a huge exposure. For large banks, these losses may be manageable because their profits are rising and their capital base is stronger. But for the small regional banks and community banks, the losses are more painful. The slide also shows unrealized losses on yen bonds as a share of the risk-weighted assets, around 2% for regional banks and around 4% for the community banks. That matters because banks need capital cushion to absorb the losses. If too much capital is tied up in the low-return bonds, smaller banks may have less flexibility to lend, invest, or to respond to stresses. In simple terms, these banks are carrying assets that looked safe in the zero-rate era, but now are becoming a burden in the higher-rate era. This slide explains how banks can make balance sheet risk look smaller than it really is. One way is by marking the bond as held to maturity on the paper. This means the bank intends to hold the bond until it is repaid, so it does not have to immediately recognize the market losses in the same way as bonds marked for sale. This can reduce the visible volatility, but it can also hide the stress. The slide shows that the share of the long-dated Japanese government bonds marked as held to maturity has risen sharply from zero in 2019 to nearly half by 2025. That is a major change. The danger is that the accounting treatment does not eliminate the economic reality. If a bank needs cash and is forced to sell those bonds, the losses becomes real. That is why the slide references the Silicon Valley Bank in 2023. SVB's collapse shows how unrealized losses on the bonds can suddenly become a major problem when depositors withdraw money and the bank needs the liquidity. Japan's situation is not exactly the same, but the lesson is important. Hidden losses can stay hidden only until the pressure forces them to open apart. This slide looks at a consolidation as one possible solution for the Japan regional banks, that is the mergers. Smaller banks are facing several pressures at the same time: weaker deposit growth, shrinking local population, limited digital resources, and higher operating costs. The slide gives the example of the Aichi Bank and Sanjusan Bank agreeing toward 20 trillion merger. The logic behind such mergers is clear. By combining, the bank can gain the scale, reduce the duplicate cost, strengthen their balance sheet, and compete more efficiently. But the slide also warned that mergers alone are not enough. Regional banks still need to solve the deeper structural problems. They need to improve the digital services, build stronger fee-based businesses, deepen the local customer relationships, and become much more efficient. So consolidation can help, but it is not a magic solution. A merger may make a bank bigger, but it does not automatically make it stronger. Long-term resilience will depend on whether the banks can adapt to Japan's demographic and economic reality. This slide presents the central choice facing the Japan's banking system. On the left is the risk of delay. If the weak banks are not addressed early, the pressure can build. Losses may rise, failures may become more likely, financial stability may be threatened, and the regional economics may suffer. This is especially important because many small banks serve local communities. If those banks weaken, the impact is not limited to the shareholders. It can affect the local businesses, household, and regional investment. On the right side, the slide shows the better path forward. Japan can tackle the big banks early, encourage healthy mergers, strengthen the governance, support innovation, and build a much more resilient financial system. The main idea is that end of the zero rates create opportunity, but it also speed up the need for action. The faster Japan moves away from the zero rate era, the sooner weak businesses models will be tested. Banks that act early can adapt. Banks that delay may face a much more harder reckoning later. The final slide brings the story together. Japan's banks are standing at a turning point. After decades of near zero rates, they finally have a chance to earn better margins and rebuild the profitability. But this new era will reward only those banks that moves with speed, scale, and strategic clarity. The key actions are clear. Banks need to strengthen their core lending and deposit businesses. They need to pursue scale through mergers, alliances, and partnerships where necessary. They must invest in digital platform and innovation because customers now expect modern banking services. They also need to manage risk proactively, especially the credit risk, market risk, and the liquidity risk. Most importantly, the banks must continue serving communities and creating the real value. This is especially true for regional banks because their future is tied closely to the future of the local economies. The bottom line is simple: the zero rate era is over. This created